Welcome to today's video, where we dive into crucial advice for navigating the turbulent financial waters of 2024. As economies shift and the traditional investment landscape changes, it's vital to adjust our strategies to safeguard and grow our investments. Let's break down the transformed investment approach for a recessionary period, offering you both wisdom and actionable steps. Key point 1. Recognize the economic shift. The economic landscape has drastically changed in recent years, prompting a need to rethink where to park your cash. Traditional banking might not offer the safety and returns it once did. Take, for example, investors once considered corporate bonds a relatively safe investment, but with companies facing increased default risks due to economic instability. Reassessing this belief is crucial. Also, the appeal of high-yield savings accounts has waned, as interest rates have failed to keep pace with inflation, effectively reducing the real value of the savings over time. In the past, parking money in banks was seen as safe, but with low interest rates and potential bank risks, it's not as secure or profitable. Banks often invest your deposits in government bonds or loans, earning much more on your money than they pay you in interest. Understanding that you are essentially lending money to the bank is crucial. You're a creditor, and in the case of a bank failure, you could lose your investment. Key point 2. Opt for safer, more lucrative alternatives. In response to changing economic conditions, shifting your funds from traditional bank accounts to safer alternatives like US Treasuries can be a wise move. Instead of traditional savings, consider Series I savings bonds, which have inflation-adjusted interest rates, providing a more stable and potentially higher return in inflationary times. Money market funds, while not insured, typically offer higher interest rates than savings accounts and maintain a stable share price, making them an attractive alternative for holding cash. US Treasuries are seen not just as investment vehicles, but as safer bank accounts with the US government less likely to default than banks. These can provide higher returns than bank deposits and come with the option to take loans against them, offering liquidity and earning potential. This approach turns traditional cash holdings into a more active part of your financial strategy. Key point 3. Investment strategy. Overhaul. Adapting your investment strategy to focus on assets and areas you understand deeply can lead to more significant returns and reduce risk. An IT professional might invest in tech startups or cloud computing firms, using their industry knowledge to assess the viability and growth potential of these investments better than someone outside the industry. A real estate developer could shift focus to investing in property markets they are most familiar with, such as residential properties in high-demand urban areas, rather than venturing into commercial real estate amid a shifting work environment. The shift from a diverse portfolio to a focused investment in known areas like the service industry, where one has expertise, mirrors successful strategies used by billionaires. Investing in what you know reduces the inherent risks involved with unfamiliar markets or industries. This strategy emphasizes depth over breadth, encouraging investments in areas of personal strength and understanding. Key point 4. The barbell strategy. This investment strategy balances safe investments on one end with potentially high-return investments on the other, minimizing exposure in the middle. On the safe end, one might choose to invest in government-insured deposit accounts or stable value funds that provide steady, low-risk returns. On the high-return end, venture capital investments in emerging technologies could be pursued. An investor could keep a significant portion of their portfolio in conservative, dividend-paying stocks while allocating a smaller, aggressive portion to trading cryptocurrency, balancing steady income with high growth potential. You might invest heavily in both secure assets like bonds and high-risk, high-reward areas like private equities or real estate. The idea is to have stability through safe investments while chasing growth through more speculative ventures. This approach allows for security during downturns and capitalizes on upswings. Key point 5. Return to core competencies. In uncertain times, reverting to investing in industries where you have the most knowledge and experience can provide security and growth. A marketing expert could invest in digital marketing agencies or ad tech startups, sectors where they can apply their knowledge to directly influence and drive growth. A seasoned chef or restaurateur might find better success investing in the food and beverage sector or starting a consultancy service for up-and-coming restaurants rather than investing in completely unrelated fields like biotechnology. Investing in industries you understand allows you to better assess risks and opportunities, leveraging your expertise for better returns. For instance, if you have a background in the medical field, increasing your stakes in pharmaceuticals or medical device innovations might yield better outcomes than venturing into unknown sectors. This strategy is akin to placing bets on familiar grounds where you can predict trends and shifts more accurately. Adapting your investment strategies to better suit the economic conditions of 2023 is crucial for protecting and growing your wealth. By understanding the risks of traditional banking, seeking safer alternatives like US Treasuries, and focusing on investment areas within your expertise, you can navigate through economic uncertainties more effectively. Remember, the key to successful investing during a recession is not just where you put your money, but also how well you understand those investments. Join us as we explore more strategies and insights that help you stay financially robust in challenging times. If you found this guide helpful, please like, subscribe, and share your thoughts in the comments below. Let us know how you are adjusting your investment strategies to tackle the current economic climate. Thanks for watching, and stay tuned for more financial wisdom.